Welcome to episode 5 of the Lost Lessons of Money series, where we cover the topic of the dot-com boom and bust in 20 minutes. In 1999, the internet was supposed to change everything, and it did, just not the way anyone expected. A single idea, that eyeballs equal profit, inflated one of the greatest bubbles in modern history. Billions vanished overnight. But what no one realized was that the real product being sold wasn't technology, it was belief. If you're enjoying this, please like, share, and subscribe to Finance Arcana. The late 1990s were electric. Wall Street didn't just discover the internet, it weaponized it. The mechanism was the initial public offering, or IPO. Investment banks, once the sober gatekeepers of capital, now operated a high-speed conveyor belt, taking fledgling dot-coms, packaging their stories of future disruption, and selling them to a public ravenous for a piece of the digital revolution. This was the IPO pipeline, a frantic race to take companies public, often just months after their creation. The roadshows were legendary, charismatic young founders pitching world-changing ideas to rooms full of eager investors, all desperate not to miss out on the next big thing. But one memo revealed a shocking truth. The old metrics were declared obsolete. Profits, a relic of a bygone era. Revenue, a secondary concern. The new god was potential. A company with a catchy name and a plausible-sounding idea could achieve a billion-dollar valuation without ever having sold a single product. Established giants of industry, with their factories and decades of consistent profit, were suddenly seen as dinosaurs, their market capitalizations dwarfed by startups operating out of rented office space with little more than a website and a dream. That suffix, .com, became a magic wand. Brick-and-mortar businesses would announce an internet strategy, add .com to their name, and watch their stock price explode. It was a frenzy of rebranding, a linguistic gold rush where two syllables could be worth hundreds of millions of dollars on paper. Investors called it the new economy. This wasn't just speculation. For many, it was a belief system. Proponents argued that the internet had fundamentally rewritten the laws of business. The goal was no longer immediate profitability, but to achieve first-mover advantage, to be the first and biggest player in a given online space. The strategy was to capture eyeballs, attracting as many users as possible, as quickly as possible, at any cost. The assumption was that once a company dominated a market, profits would inevitably follow. It was a seductive theory that justified burning through cash at an astonishing rate. And the fuel for this fire was an unprecedented torrent of venture capital. Money flooded into Silicon Valley. VCs weren't just funding ideas, they were in a bidding war against each other, driving pre-IPO valuations to astronomical heights. The pressure on founders was immense, not to build a sustainable business, but to spend the money as fast as possible. Burn rate became a badge of honor, a sign of aggressive growth. This environment created the cult of the young, disruptive founder. Experience was a liability. A track record was irrelevant. All that mattered was the pitch. 20-somethings fresh out of college were handed 9-figure checks and hailed as visionaries, their faces gracing the covers of magazines. It was a world where charisma trumped competence, and no company better symbolized the era's magnificent, tragic absurdity than a startup with a simple idea: selling pet supplies online. Its name was Pets.com. Backed by a staggering amount of venture capital, the company embarked on a marketing blitz of epic proportions. The centerpiece was a charmingly sarcastic sock puppet mascot who became a national sensation after the company spent millions on a Super Bowl commercial. The ad was a hit. The brand recognition was immense. The company went public a month later, raising another $82 million. Its ticker symbol? PETS. On paper, it was a roaring success, but beneath the euphoria, a dangerous equation was forming. The business itself was built on a fatal flaw: growth without profit, valuation without substance. While revenue was growing, the company was losing a fortune on every single order. The logistics were a nightmare. Shipping heavy bags of dog food across the country was ruinously expensive, often costing more than the product itself. They were effectively paying customers to take their goods. This was the model at the heart of the dot-com bubble. Spectacular growth, fueled by investor cash, completely detached from the reality of profit and loss. And one chart predicted the exact day. It was a digital gold rush without any gold. In an era where physical assets were the bedrock of corporate worth, a single question echoed: how do you value the future? Suddenly, earnings were relics. The conversation shifted to new nebulous metrics. Eyeballs per page, raw visitor numbers, became the new currency. Stickiness measured how long a user lingered, as if inertia was a proxy for revenue. And the most seductive concept, network effects, promised that a service becomes exponentially more valuable as more people use it, justifying burning billions in pursuit of scale. The relationship between customer acquisition cost, CAC, and lifetime value, LTV, became a central article of faith. The logic seemed simple: spend to acquire a customer, and they'll pay you back many times over. But the lifetime value was often a wildly optimistic theoretical number, while the acquisition cost was terrifyingly real. The actual path to profit was a detail for later. Closure. An internal Pets.com memo admitted shipping killed margins. Unit economics never worked. The narrative was that the internet was a fundamental paradigm shift where old rules didn't apply. Wall Street, hungry for IPO fees, became the loudest cheerleader. When skeptics asked hard questions, a three-word phrase ended any argument: first mover advantage. It was the ultimate incantation, promising that being first guaranteed eventual dominance. Even the Federal Reserve seemed hypnotized. Under Chairman Alan Greenspan, interest rate cuts made money cheap. A torrent of capital went searching for higher yields, and the dot-com story was the most seductive tale on offer. This flood of liquidity acted as an accelerant, making the distant promise of future earnings seem far more valuable. Money was cheap, the narrative compelling, and everyone wanted in. But deep inside the numbers, a dangerous secret was hiding: the burn rate. Companies were burning cash faster than they could raise it. Their lifespans weren't measured in years, but in months of runway until their cash hit zero. The entire ecosystem was a collective hallucination, a feedback loop where rising stock prices validated flawed models, which in turn justified even higher prices. The disconnect between perception and reality was a chasm. And yet, the market kept rising. March 10, 2000, the Nasdaq hit 5,048. Closure. The IPO pipeline outran diligence. Rates turned, liquidity vanished, and gravity returned. By the end of the year, it would lose 78% of its value. The bubble burst, and with it, the dream of effortless wealth. Overnight, giants collapsed. Pets.com, bankrupt. Webvan, bankrupt. eToys, bankrupt. The list went on. Billions in paper wealth disappeared. Retirement accounts wiped out. And the same institutions that hyped the boom downgraded everything in panic. Greed turned to fear. The internet, once a symbol of progress, became a graveyard of broken promises. It wasn't just bad luck. The spectacular implosion of the dot-com bubble wasn't an unforeseen accident or a freak economic event. The crash exposed how Wall Street had sold illusions dressed as innovation. The grand narrative was that of a new economy, a digital promised land where the old laws of finance no longer applied. Profits were a relic of the past. What mattered now were eyeballs, stickiness, and first-mover advantage. It was a seductive story, and the investment banks were its most powerful storytellers. They perfected a form of financial alchemy, transforming speculative business plans with no revenue, let alone profit, into multi-billion-dollar public companies. The engine of this machine was the initial public offering, the IPO. Investment banks like Goldman Sachs and Morgan Stanley didn't just underwrite these offerings. They manufactured the frenzy. They orchestrated elaborate roadshows, flying young, charismatic CEOs around the world to pitch their grand visions to rooms full of institutional investors. The goal wasn't to scrutinize a business model, but to build unstoppable momentum. The banks earned enormous fees, typically a 7% cut of the total funds raised. For a billion-dollar IPO, that's $70 million. With that kind of money on the line, the pressure to push deals through at any valuation was immense. They weren't just opening the door to public markets, they were holding it open for a stampede and taking a toll from everyone who ran through. And who was there to provide a sober second thought? The research analysts, the supposed watchdogs for the investor. But their leashes were held by the very banks they were meant to keep in check. Officially, a Chinese wall was supposed to separate the investment banking division from the research department. In reality, this wall was made of paper. Analysts, whose compensation was often directly tied to the banking fees their positive reports helped generate, became the loudest cheerleaders. Giving a hot IPO prospect a sell or even a hold rating was career suicide. The result was a sea of strong buy recommendations. At the peak of the bubble, for every one sell rating issued by a major Wall Street firm, there were more than 100 buy ratings. It was a complete breakdown of objectivity, a systemic conflict of interest that turned gatekeepers into salesmen. A single phrase greased billions in fees, first mover advantage. And the media, far from being a skeptical fourth estate, became the primary amplifier of the mania. And journalists, caught in the mania, amplified the myth. The 24-hour news cycle of emerging financial networks had an insatiable appetite for content, and the dot-com saga was the greatest show on earth. CEOs became messianic figures, gracing magazine covers and delivering bold proclamations on live television. Stock tickers became a national sport. The narrative was intoxicating, a democratic revolution in wealth creation, where anyone with a modem and a brokerage account could get rich. Financial news became indistinguishable from entertainment, focusing on the drama of soaring stock prices while glossing over the glaring absence of fundamental value. They weren't just reporting the story, they were a central character in it. It wasn't a market, it was theatre. A carefully scripted performance where everyone played their part. The charismatic CEO was the leading man, the investment bankers were the producers, and the analysts were the critics writing paid-for rave reviews. The public, the ordinary investors, were the audience, paying for a ticket to a show they were told was the future. They sat in the dark, mesmerized by the spectacle on stage, never suspecting the set was made of cardboard. And behind the curtain, the insiders cashed out. While the public was being urged to buy and hold for the long term, the founders, venture capitalists, and executives were quietly, legally liquidating their holdings. They cashed in their stock options the moment they could. They sold shares in secondary offerings as soon as their post-IPO lockup periods expired. They knew the real value of the confetti they were selling. They were exiting the theatre before the final act, leaving the audience to face the fire. When the curtain finally fell, it fell hard. Ordinary investors, the audience, paid the price. Retirement accounts, college funds, life savings, all vaporized in a matter of months. Trillions of dollars in shareholder value vanished. The psychological toll was just as devastating. An entire generation's faith in the promise of the stock market was shattered, replaced by a deep and bitter cynicism. But even as the wreckage smoldered and regulators scrambled to erect new safeguards like the Sarbanes-Oxley Act to prevent a repeat, a different story was quietly unfolding. A few survivors, companies that had been dismissed alongside the failures, began to build the next empire. They were different. Amazon, battered but not broken, wasn't just selling books online. It was methodically building a global logistics and cloud computing backbone. Google wasn't just a search engine with a clean interface. It was creating a new, auction-based model for advertising that would come to dominate the internet. eBay wasn't just an auction site. It was pioneering a scalable marketplace built on digital trust between strangers. These weren't companies built on hype. They were built on utility, on solving real problems, on creating tangible infrastructure. Out of the ashes of hype came infrastructure that would reshape the world. But one lesson outlived the wreckage: usefulness beats spectacle. If this all sounds familiar, it should, because the playbook hasn't changed, only the actors. Today it's AI, crypto, SPACs, meme stocks, same euphoric promises, same belief in exponential growth, and the same illusion that this time the technology is different. But bubbles aren't built on technology, they're built on psychology. When belief outpaces fundamentals, history resets the clock. The dot-com boom was more than a crash. It was a mirror, a reflection of how innovation turns to speculation, and how hope becomes currency. Every bubble begins with a good idea, taken too far. The internet changed the world. But belief, unanchored by discipline, always burns brighter than reason. As the next tech wave rises, remember the first, because history doesn't repeat. History doesn't repeat, it liquidates. If you enjoyed this, please like, share and subscribe to Finance Arcana. Thank you for watching the dot-com boom and bust in 20 minutes. Stay tuned to our other upcoming episodes of the Lost Lessons of Money series.